Let us now move to the application of funds or uses of funds. On the asset side of the balance sheet, you find two broad classifications, non-current assets and current assets. Non-current assets are further grouped under fixed asset and other assets. Fixed assets are used to manufacture goods or deliver services. Tangible fixed assets are physical assets like land, building and machines. Intangible fixed assets are assets which are not in a physical form but used for producing or selling products or delivering services. Patent, copyright, brands and high end of a software are examples of intangible assets. Capital work in progress is the next item. It is assets which are acquired, but we are yet to put into use, or assets under construction. Let us examine the schedule that shows a fixed asset. The line items are different types of fixed asset like land, building, machine, and it includes intangible assets. On the column side, you find gross block, depreciation, impairment and net block. Gross block is nothing but original value of the fixed asset. It includes all expenses incurred in connection with bringing the asset to the operational condition. Invoice price, duties, taxes, transport expenses, special foundation required for erecting this machine, interest paid on borrowed money till the asset put into use, travel expenses, boarding expenses of foreign technicians who came to configure the machine, trial run expenses, they are all included in the gross block. Gross block value is important. It is the amount which get depreciated over the years and charged to the profit and loss account. The term depreciation is related to tangible assets. If you buy an intangible asset like a brand, it is also charged to the P&L account over the years. We call this as a amortization. Suppose a telecom company pays spectrum fee to get license. It is amortized over a period of 15 to 20 years based on the license agreement. The next column is the impairment. Impairment is reduction in the value of asset due to extraordinary reasons. It is similar to depreciation. And the last column shows net block value of the asset. It is equal to gross block less depreciation and impairment. Under each block, you observe values at the beginning of the year, additions during the year, deductions during the year and value at the end of the year. If you buy a new asset, you will find an entry in the addition. If you sell an old asset, you will also see an entry under the deduction. Under depreciation, addition refers to current year depreciation, deduction refers to depreciation of asset which have been sold. An illustration will be useful to understand the fixed asset related entries. Suppose you buy a machine for 10 million. The useful life of the machine is estimated at 10 years. You will provide depreciation at the rate of 1 million per year. Suppose you sell the machine at the end of 6 years for 2.5 million. How entries are made? The first entry is simple. Machine plus 10, cash and bank minus 10. Every year the entry for accumulated depreciation is plus 1, expenses minus 1. The entry is repeated for 6 years. At this point, your machine account will have a balance of 10 million and accumulated depreciation account will have a balance of 6 million. When the machine is sold, we need to reverse both entries. In addition, we got a cash of 2.5 million. This should also be recognized. The balance in the equation is profit or loss on sale of machine. Let us now try these entries. Machine minus 10 because the machine is going out. Cash and bank plus 2.5 because we are getting cash. These two entries are on the asset side. The net effect of the asset side is minus 7.5. On the other side, the entries are accumulated depreciation minus 6 and expenses minus 1.5. This makes the two sides equal. Expense of minus 1.5 is a loss on sale of fixed asset. That is, you bought an asset worth of 10 million, depreciated or got the benefit from the asset worth of 6 million. The balance book value of the asset is 4 million. You sold this machine for a 2.5 million. The difference of 1.5 million is a loss on sale of machine. The other group of non-current assets are assets which are financial instrument or financial claims. Investment in subsidiary company equity shares is a non-current assets. Loans and advances given to others but recoverable after 1 year is a non-current other assets. An example is deposit with various government agencies. Let us now move to the current assets, which is the next group of items. Current assets are inventories, receivables, cash, anything that are likely to be converted into next form. Inventories consist of raw materials, work in process and finished goods. Valuation of inventory is one of the most important decisions in accounting. Inventories are valued based on the conservatism concept, that is cost or market price, whichever is lower. The cost price depends on inventory accounting. Raw materials are purchased at different prices throughout the year. Finished goods value also vary due to different cost structure. There are different methods of inventory accounting used for computing the closing stock value. FIFO or first in first out, LIFO or last in first out, and weighted average methods are possible options. In the annual report of Asian Paints, you will find a section called Significant Accounting Policies. There you will find how inventories are valued. Asian Paint in its annual report 2014-15 states, in determining the cost of raw materials, packing materials, stock in trade, stores, spares, components and consumables, weighted average cost method is used. Asian Paint total asset is 7,273 crores. Of this, 3,104 crore is a non-current assets and the balance is 4,169 crore and it is current assets. Another 1,800 crore are in investments. Like many large companies, Asian Paint is also a cash rich company. There are few items that you will encounter in balance sheet. Deferred revenue expenditure is one such item. It is not there in the Asian Paint balance sheet. Suppose your company is doing some restructuring of businesses. To reduce the workforce, it offered voluntary retirement scheme or VRS. To incentivize the worker, your company also offered 10 lakh rupee per employee as an additional gratuity. How do we treat this in accounting? One option is cash minus 10 lakh and expenses minus 10 lakh for each employee. This will have an immediate effect on the profit of the year. We know the benefit of VRS or restructuring will happen in the future. Conservatism requires us to charge the expenses in the same year. But there is another concept, matching concept, that requires us to defer the expenditure over the years where the expenses are matched with the revenue. If we decide to defer the expenditure to the future, our entry is cash minus 10 lakhs per employee, deferred revenue expenditure on the asset side plus 10 lakh per employee. Like any other asset, a part of this asset value should be transferred or charged to the profit and loss account every year. Let us summarize our discussion on balance sheet. Balance sheet shows sources and uses of capital. Shareholders of Asian Paints invested 4,230 crore rupees. Long-term suppliers of capital provided 285 crore. Suppliers of goods and services and other short-term lenders have provided 2,758 crore. In all, Asian Paint has used 7,273 crore to run the business. On the application side, Asian Paint used 2,105 crore on fixed asset. In addition, it used 4,169 crore on current assets. It may be difficult for us to discuss all terms that will normally appear in the balance sheet. We discuss most of the items. You can understand the other items by reading the notes attached to that item.